Rory, you're going to host this next panel. We're going to look about beyond investment trust. How are we going to raise more money for the whole fintech sector? Over to you, Rory.
All right, well, thank you very much, everyone. It's great to be here, and it's having sort of been part of this industry for the last few years, it's really exciting to be part of it, working for a platform now as well. So as of 2 weeks ago, joining Lendable on the UK consumer loan space. But I think the point of this panel today is to talk about, where the next wave of capital, where capital is coming from to fund platforms and just more broadly in the marketplace space. But I think we'll start by just getting some introductions because we've got a really good, diverse group of panelists today. Katarina, would you like to start?
Hi. Katarina Lüth. I'm head of Europe at Raisin. Raisin is in a marketplace for savings and investment products, ultimately allowing, on the one hand side, retail savers access to term deposits, overnight accounts, and investment products across Europe, and on the other hand, providing banks with banks or potentially peer-to-peer lending platforms with a funding source.
I'm Oliver Akins. I'm head of capital markets at Prodigy Finance. Prodigy Finance is an international super prime education lending platform. And we've made $500 million of loan origination since 2007.
Hello, my name is Rens. I work at Aegon. Aegon is a large insurance company in the Netherlands, but also a bank entity. I do the financial due diligence on those platforms we invest in. So currently we're investing in 5 different platforms in Europe, like SOPA, United Credit, Funding Circle, Oxmoney, United Credit, I Thanks.
Tap the microphone. Yeah. Hi, my name is James Newsom, founder and managing partner of Arbor. We do the things in this market which investment bankers don't bother to do. We raise capital. We're currently advising one of the leading platforms on raising money. And we do M&A projects as well in this market. Primarily, actually, so far in the mid-market, but now happily involved in this sector too.
Thanks, James. And I think one of the titles for this panel today was around sort of like the next wave following the closed-end funds being less predominant in this market. And I think for those of us who've been in and around this space for the last several years, will know that at a time where all the platforms were first sort of growing up, the closed-end platforms, the PTPGI, the Victory Parks, the Rangers, all these guys, had also grown up at a very similar time. They were nascent platforms and nascent funding sources, and naturally over time we've seen the very same trends. That we're in a low interest rate environment. That there's a thirst for yield. It takes time for platforms to mature, for incumbent sources of capital to look at a space and to get comfortable and to do the due diligence. But also, there's been a lot of new source of capital coming on board. I mean, I think I'll start sort of like the questions today with one of the sort of the older names and the sort of blue chip sort of investor names on the panel with Aegon. I mean, Ren's like Aegon is a classic sort of name in insurance and banking in the Netherlands. Has become one of the sort of like first pension bank providers to really sort of like partner with platforms. Can you talk to us a little bit about the sources of capital within your institution that have been getting involved, the difficulties, and whether you see more pension funds and insurers sort of like coming on board over the next couple of years?
Yeah, sure. I think it started like 4 years ago when we first bought a portfolio of loans from a Dutch bank. And we saw they were very good new asset classes which we haven't had access on before. And those new platforms, which are SOPA, Funding Circle, or other platforms I just named, they provided access for us to those consumer loans or SME loans which we would like on our book. And I think the due diligence process, we are a very large company, and it takes some time to go to all different entities, different boards to get approval for an investment. But once we are in investment with a platform, then we're not only there to take their loans and run off, we're there for the long run and also help them increase their internal governments. So I think it first starts at my team. I do the financial due diligence, so we say, okay, what is the best platform to invest in, where do we see the yields? But once that stamp is given, like, okay, this is a good platform, then we go with the whole team, with guys from legal doing a legal due diligence, compliance due diligence, operational due diligence. So it takes lots of time. So I think if you ask one of the platforms we invested in, that you do have to have some patience when you want to invest with us. I think Funding Circle, we have been spoken for more than over a year before we actually bought the first loan from them. But eventually we are there for the long run.
Great. I mean, James, you've had a career focused on sort of like taking assets and structuring them and making them more relevant to a particular pool of capital. You've worked with insurance and pension funds and more mature sources of capital for a lot of your career. Can you give us some sort of insights in how that sector is currently approaching the space and whether there's particular structures which work better for them?
Yeah, I mean, at the moment there's a convergence going on. I mean, when this market started in about 2010 in earnest, another market started in parallel, which is the mid-market sort of private equity-based lending. That market's done now 850 billion on its own, and this market has done, I don't know, give or take 50 or 100 billion. So the convergence is that really neither of them was an asset class that pension funds could actually tick a box for in 2010. But now pension funds and insurers can tick that box, and my feeling, and I think we've heard it from panelists earlier, is that this convergence could mean another 100 or 200 billion coming into this market from the guys who so far have really been doing quite lumpy investments, say a 500 million or 1 billion fund in a classic private equity structure, GP, LP structure, and the number of positions in that fund could be as few as 15. So you may see that some of the loan managers, I mean, recently, I think it was Permira financed Soho House with a 375 million euro loan. Groups like ICG are doing 500 million euros in one loan. And so the investors, to answer your question, so the investors, pension funds and insurers, looking at that market and getting, say, 6% net on what's called unitranche. If a platform now can show even 4 or 5% net with greater granularity and a transparent underwriting process, then I think you should see actually that's really one of the main sources of capital in this market will be some of that market coming over here quite quickly. I mean, there's some hurdles we can discuss. There are some conceptual differences, some philosophical differences, but we're working with several investors now who are beyond that and are about to commit to one of the platforms.
Okay, and we'll come back to it later, but is the pricing, is what they believe is getting taken out at each stage of ultimately creating the investment for them a big part of their consideration, or is it more just transparency and risk?
Yeah, of course. I mean, that's one of the main philosophical differences. I mean, pricing is linked to an idea of alignment of interest. From that market, they're used to the idea of skin in the game being in carry and performance fee. And so most platforms are really charging a servicing fee and then maybe taking some upfront fees, right? So when you're talking to investors in that market and you say, well, we're not going to be charging you carry, we're not going to be taking carry or performance, but our members are all owners of the stock in the platform. The investors have to get used to a pretty different way of looking at it, right? And alignment of interest and fees are very important. Is there really a bogey, like how much somebody will pay in fees? If you add up the amount of carry that goes out of a private debt fund, if it achieves its return target, it's a mouth-watering amount of money. So when investors see that, I think this market can actually show a lot of efficiency in comparison on pricing.
Okay, fantastic. I mean, Katarina, like your business model is very different again, and I think what was most interesting to me when I was looking at it was the ability for depositors to be able to find international sort of like banks to be able to maximize their returns, but also in turn it means that new banks setting up or old banks in particular markets are able to access an international group of customers. How are you seeing all this whole thing developing?
Indeed, and I think I'm not telling anything new, but getting, let's say, when we talk about retail investors, getting retail investors, especially when we talk continental Europe, to invest into alternative finance, peer-to-peer lending type platforms, it's extremely difficult and cumbersome because it probably is a higher amount of risk, especially if they haven't really done it before. They maybe don't know how to properly diversify, etc. So a lot of investors, or I would almost call them savers, actually are extremely risk averse, especially when we go to Germany, but most of continental Europe as well. So for them, actually, a classical, old school, boring savings product such as a term deposit or fixed rate bond is oftentimes more what they're looking for, but they do want to get a high interest rate on that, so which is where we come in. But ultimately, indeed, what we do is we provide banks, and among them a few neobanks or United Credit as also an alternative lender with deposits. So it's a fairly low cost source of funding because it's a guaranteed deposit for the customer, so the customer isn't taking any risk. But on the other hand, what we do is we take away a lot of the work that the alternative finance provider would have on the other end, because if you go, let's say, retail ticket sizes, you really need to spend a lot of effort and a lot of acquisition cost on finding those customers, which ultimately we take away all of that processing, all of the initial KYC of the investors from a retail side for those platforms. So indeed, on the one hand side, we have a bit of a risk transformation where retail savers don't need to take the higher risk. On the other hand, it's a fairly low cost way for funding platforms to get access to capital.
Fantastic. So Oliver, like, you guys are operating in a particular niche of international student lending. And I guess, one of the things that we were talking about earlier when you think about sources of capital for platforms is that certain types of platforms, especially where they have a particularly sort of like focused asset class, they will have a certain number of niche capital providers who are almost like dedicated or in perfect position to provide them capital. I mean, in the same way that an SME lender will have access to the British Business Bank or some of the European funds, you guys will have access to sort of pseudo-government bodies in certain circumstances. You want to talk to us a little bit about how you go about finding sort of like the sources of capital which are sort of most appropriate to your business line?
That's right. We've certainly had some themes that have been very successful. Impact investing has been one theme that's certainly been a successful source of capital for us. We've raised about $300 million through our bond program, partnering with Credit Suisse through their impact investing team in Switzerland. And I think that's largely been down to the unique nature of our borrowers, who are top students at business schools and engineering schools around the world in the international student space. So if you look at the characteristics of those students, many of them travel from developing countries and don't have any alternative access to finance. And also, once finishing the study, they often return home to create jobs and enhance their home economy. So some very popular themes that meet people's investing goals. And we like to think of ourselves as providing investors with both a financial and a social return. But I'll tell you what is critical about that is that we don't view impact investing as any sort of charitable endeavour. We take on that challenge by providing investors with what we see as a competitive or a superior risk-adjusted return opportunity. And I think that's where impact investing is at its most powerful. The second theme where we have been very successful raising capital is in the bank space. I would say that as the ex-banker on stage, but I do think there's a very strong relationship that needs to exist between platforms and banks. Banks are often viewed in a negative way in the alternative lending space, but actually they are the natural aggregators and source of large pools of capital. And in our position as platforms providing innovative ways to access new consumers that banks either don't want to reach or they've chosen that they're not going to reach, partnering up to access that capital is key. And going forward, I think we will see the relationship between banks and platforms being less of a transactional experience and being more cooperative.
Thanks. And I mean, I guess it goes to say, like, I mean, banks are obviously, you've got investment banks who have worked with Zopen Funding Circle to bring them to the securitization market. You've got banks that are providing warehouse facilities, both large and small. You've got the challenger banks who are increasingly setting up forward purchase agreements to buy assets directly onto the balance sheet. So yeah, there's no doubt that I guess the banks are a hugely important part of this ecosystem going forward. And on that point, Rens, I mean, I guess you guys have both a bank balance sheet and an insurance balance sheet. I mean, can you talk to us a little bit about the difference between those two as it pertains to buying assets? Do you mean you literally just buying assets onto both, or are there different sort of return metrics and different assets that fit better on each one?
So there are different duration preferences for both the bank or the insurers. The bank likes shorter term duration, while the insurance company likes more the longer term duration. Concerning the risk, there's not that much of a difference where the bank or the insurer is looking for. However, what we do see is that currently the bank is, we started a bank a couple of years ago, it's called Knap, which is all fully online bank. It's still a bit of in the startup phase, so we are able to move a bit faster with the bank compared to the insurer. So currently we use the money from the bank to step into those platforms. So currently the investments I named are mostly for the bank balance sheet. But once we're there with the bank, then we can also add the capital of the insurer, which is the capital at the insurer. The balance sheet is much larger, so there's much more opportunity for them. But it just takes some more time for the insurer to adapt to this new asset class, to know the risks, and get comfortable with the risk they take.
Okay, thanks. And James, coming back to you for a second, the other question I had was sort of like, if you look at different types of platforms as they go through their maturity, they have different stages of being ready, I guess, to access different types of capital. Do you want to talk to us a little bit about like some of the work you're doing now in respect of at what stage does a platform need to be before it can legitimately, pursue some of these structures?
Yeah, I mean, the structure I talked about earlier, the LP world, I mean, really, you're going to have to do a fund of a minimum of 200 million, which means you're going to have to have the capacity to be able to take quite big checks. But that's probably the minimum, because of course the Scandinavian investors in the pension fund world, they will give you they'll give you a cutoff point saying they can't be more than 25% of a fund, and their ticket size is 100 million. So I think that's one of the unfortunate technicals of the private credit space, which is some of the better ideas don't get accessed by larger investors. So if there were another layer in between, some form of fund of funds or fund of platforms, then we're getting into economic problems. So people say, well, wait a minute, what about the layers of fees? But interesting, the way the hedge fund world started and the way the private equity world started, there was a lot of funds allocation. So there probably is room there somewhere for one of the big houses, a BlackRock or somebody like that, to do a fund of platforms, and then you could get some really large tickets from the sovereign wealth funds. Otherwise, you're really looking, in terms of the development of platforms, you're probably looking at the top 3 that could actually take in a large private equity style institutional fund. That's the LPGP, the classic Luxembourg or Dublin structure. I mean, there may be some other ways of doing it, more bespoke programs for particular types of investors, funds of one. But really, I'd say the prohibiting factor is 5 to 10 year track record and the ability to actually receive a check of more than 200 million.
Great, thanks. Just a couple more questions, and then we'll look at the board briefly. Katarina, as you look at the growth of your platform, you guys have been putting a lot of investment in and growing really fast, and really providing that link between retail and these banks, across Europe. What do you see as sort of like the next sort of development in your platform? Are you sort of like have ideas around new products?
Yeah, so today is exactly the right day, of course, to talk about that. So there's 2 areas into which we're developing. So on the one hand side, we started off indeed as a platform that helps banks gather funding, but looking at the current interest rate environment and the general current liquidity environment, there's actually a lot more banks out there that have access liquidity rather than too little. So we've broadened into what we call API or open banking integrations, where ultimately we offer our product as a quasi-white label product to integrate into banks that also say, hey, with PSD2 coming around, I will need to provide my customers' data to outside parties. Why don't I take advantage of that and actually keep the customer experience, but provide my customers with access to higher interest rates from other banks? On the one hand side, enhancing happiness of my customers because I can't pay them any interest. On the other hand, alleviating my balance sheet from some of that access liquidity. So that for us is one big topic. The second big topic we launched, and I think that's what you're referring to, we launched our first investment product today. So for us, it's a fairly natural move to go from pure savings products towards now also simple, globally diversified, cost-efficient ETF portfolios, which we're working together with Vanguard for in order to basically also provide customers with that second half of their usual investing needs. So they have the shorter term, 100% capital guaranteed savings product, but on the other hand, when we talk longer term, a lot of them do want to look into investments and capital markets products, so that for us is a natural evolution.
Great. Before we go to some questions, I mean, Oliver, just come back to you for a second. I guess you guys are at that interesting stage of your journey and maturity as well. You've grown a lot, you've invested a lot, you've put in place some important facilities with banks and others. What are you thinking about, when you're sort of weighing up all the various options for the next, 18 months of funding? Are there any particular sort of thoughts you have that you'd like to share with us today?
Sure. I mean, we continue to analyse the landscape around three real main core considerations, I suppose. So scalability, flexibility of financing sources, and also diversification. I think we'll continue to stick with those. There are a few areas that we're looking at trying to really develop and push forward with the platform. One is something that will allow us to eventually have the financing structure in place that we envisaged when the platform was started back in 2007, which is more of a global financing community where people come and invest with us because they want to be part of the Prodigy financing community, whether that's because they believe in what we're doing or they were a beneficiary in it somehow, or just because they like the returns. And I think what will be really interesting is how we're able to achieve that. And whether it is something that ends up being technology-led and looks really as a kind of fintech strategy in its distinguishing factors. So, for example, something involving blockchain or an ICO, but it could just be using existing financing structures in a new or a slightly different way. And the title of the panel around investment trusts is an interesting one. There's clearly weaker sentiment in that market as it stands at the moment, but there are some strong benefits to a fund structure per se for investors in terms of being able to market that to a large group of people to achieve scale and diversification, quoted NAV and liquidity, and all of these things that just make it easier for people all around the world to come and invest in the platform. So it's something that we'll be looking at very closely going forward.
Great, thanks. Yeah, and I agree completely. So just coming on to some of the questions, I mean, maybe James, the first one might be good for you. Listed funds are actually at a disadvantage because they have to be transparent, question mark.
Actually, I was going to take the second one.
Okay,
I can answer that very clearly. Right now, so this is our institutional investors wanting to invest in loans directly or funds or securitizations. Right now, my prediction would be that pension funds will invest in funds. So local authorities, corporate pension funds, private pension funds in Europe are going to be investing in funds, and you're going to see that happening soon. Insurance companies will be investing in loans directly, a bit like Aegon has, or also perhaps in securitization tranches. And so that's really when the institutional investor world, maybe hedge funds will buy the securitization tranche as well. But as of now, pension funds are not buying loans directly.
Yeah,
I think if I can add something, I think the securitization market is a good market for the platforms to start with. If you have a rating on it, it makes it much easier for a lot of institutional investors to get into it and also to get used to the assets so they can eventually buy or a fund or a whole loan later on. Okay.
I mean, I guess, Oliver, you were almost sort of like touching on this top question around the listed funds, whether, transparency is actually a disadvantage for them. And I mean, I guess the question is, I mean, as you mentioned earlier, James, like the LP structures, the current fund manager structures, you often don't have any of that transparency in the underlying. They also don't have like daily listed NAVs and all this kind of stuff. So people just don't focus as much. And some of those funds, they do go through ups and downs, and it's just less talked about. When you've got these 3 or 4 funds listed on the stock exchange, and it was so critical to the setting up of this whole business, it's sort of like people talk about it every day when things aren't going so well. There's also some very idiosyncratic reasons why some of those funds had performance issues. So they're not necessarily all to do with the very structure or themselves. And as I understand it, the Funding Circle one's working perfectly well. So, any other sort of thoughts on that?
I was just going to mention. I mean, there are obviously the comments we've made around that market so far, but from the lender side, there are also big responsibilities as a platform to take on that sort of structure if you decide you want to go down that route. Once you're listed, the bonnet is open for all to see. So if your investments perform well, then it's a fantastic piece of marketing. But if you have a wobble, then the whole world knows about it. So it's another important factor to consider.
Have you any interest in taking that last question?
Yeah, sure. So what's Aegon's view on the market not falling under the scope of AMLD? So it indeed did not prevent us from investing through those platforms. I think it just makes the work a bit harder for us. We do have a regulator which looks at our investments and at the books, the balance sheet which we're holding, and it just makes them a little bit more strict. So we have to do a better due diligence on the processes at the platforms to make sure that the company is a good company with all the processes in place, that the loans are actually loans which are given out to individuals or to companies, which is not a fake loan. So it just makes the work more harder for us that it doesn't fall under AMLD. but it's not a reason to not invest in it. When we see the search for yield continues, and when the yield is here at the marketplace platforms, we're going there, and we don't mind to be the first one in the new market.
Great. And I think if anyone has a question, just feel free to raise your hand. But I think the bottom line there and ending up on just the search for yield continues is really like an important point, because this asset class or the emergence of the ability to buy loans in lots of different formats has been driven by a fundamental search for yield. All of the traditional sources of capital have been trying to work out how to get access to that yield, and we're now, as we go through year and year and year, more and more sources of capital sort of are coming online, and
raise your interest. Because we thought Apple was very successful. No, it comes from raise your interest.
Very good. So, as I say, just coming back, I think, we're going to see more and more coming from banks, from insurance companies, from pension funds, more types of fund structures coming. We don't necessarily think the closed-end funds are finished as a concept. We think the existing ones, have a good chance of bouncing back, and we think new ones will come online. So we just think there's going to be a continued maturity. The fact is, there's a belief that private asset-backed opportunities provide us huge yield pickup for similar types of risks over other things in the market, and that's going to continue to drive demand for multiple sources of capital. Thank you very much.